Good evening, everybody. Thank you very much for joining in. This side, Rahul Magan here as the Chief Executive Officer of Treasury Consulting LLP. And today we are going to covering our financial terminal of ours, wherein we are going to tell you that how currencies move and in which direction the currency is going. So the screen which you are looking at is a blinking screen, and this screen you can very well see that the currencies are blinking up. Now, if you look at the screen, we will get to know the currencies like GBP dollar, which is trading at 1.24, your dollar to Japanese yen, which is trading 102.62, your CHF, which is trading at 101.1.01, dollar to Canadian, which is again a direct, which is trading at 1.34. Aussie dollar is getting down, which is trading at 0.7386. On the other hand, New Zealand dollar is trading at 0.70 and dollar index is 101.70. So this is a financial terminal. This is how the currencies will move. If you carefully see on your right hand side, I assume the computer is towards your right hand side, then you would get to know that GBP dollar is having a depreciation of minus 23.26% in the last 3 years. And with the depreciation of depreciation means the volatility. So minus means the depreciation. Sorry, my mistake. My mistake. GBP, yes, GBP depreciated by minus 23%. And here, if you look at and here if you look that in the last 6 months it has depreciated by minus 14.07%, which is much higher, which is much higher. Now considering this, now if we compare this with the Aussie, not Aussie, let us compare with the Japanese yen. Now with the Japanese yen, here it means that the dollar, now here in the last 3 years, if we compare this 3 year performance of the Japanese yen, then if we compare this performance of the 3 year, 1 minute, it seems to be some problem. Yes. Compare this performance of 3 years, then we will get to know that Japanese yen has appreciated by 11.12, dollar has appreciated by 11.12%, while Japanese yen appreciated by 11.12%. In the last 1 month, and especially if we compare the term, then we will get to know that Japanese yen has been depreciated by 8.44% and dollar has been appreciated by 8.44%. In the last 1 week, the percentage is 3.21%, which is very high percent. Now this is, if you look at this chart, this is crosses. Now euro dollar is a direct which is trading 1.05. Treasury Consulting LLP long ago predicted that euro dollar will go down to 1.05, and considering the fact that Italian referendum is on the cards, although the current prime minister, the current government has already said that whatever would be the result of the referendum, they are not going to step down. So it is not like a British. It is not like a British referendum when Tony Blair decided to quit and gave this to Theresa May. But he clearly said that in case of Iran, in case of Italy, he will not step down. But believe me, if Italy go for referendum and they will go to quit your so-called European Union, then euro might touch not parity, might touch less than parity. And the probability of having euro touching this is very high, because the reason is very clear. Because the reason is very clear. The reason is that people want to quit from European Union. The threat on European Union is getting rising. Henceforth, we might see euro less than 105 as well. If we compare the volatility gauges, because you know that dollar to Japanese yen is a standard pair, but the world is having a lot of volatility gauges. If we track these volatility gauges, then you would get to know that then you would get to know that the way the scene would be. If you track these volatility gauges, then then you have euro crosses and GBP crosses, and we are showing two Japanese yen crosses also. Now euro GBP is a cross, euro Japanese yen is a cross, euro CHF is a cross, but this is one of the most important pair, especially when the CHF is rising. because today Swiss franc is rising and Swiss franc has risen to 1.01. So a currency which was between 0.95 to zero point 0.9, now it is trading approximately 1.01. And the main important barometer, which is Euro Swiss franc, this is 1.07, which is moving higher, Like I will show you with the chart here. You will a chart will, I hope, should automatically come. Sorry, it is getting lower. It is getting lower because Swiss franc is rising. So euro is falling and Swiss franc is rising. You have euro CAD, which will again falling because euro is falling and your so-called Swiss franc is rising. CAD is rising, which is a direct pair. Here comes the GBP crosses, Euro GBP. We have already saw GBP dollar is a direct, which is 1.24. Now here is a chart, short chart of GBP direct. Our personal view is that if Italy will go out of this setup, if Italy will go out of this setup, then my personal opinion suggests that euro might touch 1.02 and GBP would go at least three big figures down. But at the same time, I'm not I cannot give surety of that because there is a reason behind that. The surety which we cannot give only because it is European Central Bank intervention in the GBP market. Because that is for sure that if euro will that is for sure that if Italy will put out of euro, then they will get down. But at the same time, if Bank of England and European Central Bank decided to intervene in the market, and which they would surely do because they have a good surplus money, and today today no central bank is seriously interested in terms of the balance sheet size of the balance sheet, whether they are investing in saving the economy. So nobody worries about the balance sheet. Balance sheet we will see later. Who cares about balance sheet? So in that regard, we need to wait. We need to see that how GBP will move. But I strongly see that GBP is seriously heading towards 1.22, and from where we need to see how European Central Bank and Bank of England come forward and how they are doing it. And at the same time, if you look down, then you will get a lot of crosses of GBP, and now these crosses are very good crosses since these crosses are very good crosses. Like you have GBP Aussie. Of course, GBP Aussie is a good cross and it is rising because the reason here is Aussie is falling. The denominator Aussie is falling. So by the time Aussie is falling, it would continue to increase. I don't know why Aussie is falling. In my personal opinion, that commodities are picking up. I think Aussie should move up, but all those dollar exporters who are in Australia, for them, all those dollar exporters, those who are in Australia, for them, Aussie should not get down, and all those dollar importers who are in Australia, for them, Aussie should go down. In my personal opinion, that Aussie should not go up. Aussie should not move down. I think Aussie should maintain a position of 0.85 against dollar. But at the same time, we are no one to decide here. In my personal opinion, GBP should continue to trade at approximately 1.27, 1.28, which is the right position of the GBP. And at the same time, in my personal opinion, that GBP Swiss franc would further, I think it is intact because Swiss franc is also rising and GBP is little bit here. This is one of the important crosses that we need to see, which is GBP to Japanese yen. And believe me, it has touched 180 also. Like you can see here in 2015, when Japanese yen was falling and GBP was rising, it has touched 180 also. You can very well see here. Now, GBP to Japanese yen is one of the biggest volatility gauges. It is not a risk off currency because this is not a standard pair. This is a derived pair. So this is a cross. Henceforth, we cannot term this as a risk of currency. Henceforth, we term this as a volatility gauge. And in my personal opinion, as Japanese yen is rising and it would hit 115 to 116 in near about time, so, and GBP, because of the Italian referendum, because of the pressure from Trump, and because of a lot of things, I think GBP will surely get down. In my personal opinion, GBP to Japanese yen is a sell call, conceding the fact that the probability of that Italy will go out of EU, and I don't think that ECB is in a much position to save the economy. There is a limit to ECB which ECB can do, and I don't think ECB can just do anything. You just want it, and ECB is in a position to do that. This is how things would be. And last but not least, here you have the Japanese yen crosses. You have Euro Japanese yen, which is again falling. Why not? Because Euro is getting down and Japanese yen is going up. USD JPY, we already heard a word about USD JPY, which is moving up. So this is how the world of foreign exchange moves, and this is how the crosses moves. I think that all the volatility causes and all the crosses will continue to face a lot of volatility in near term, and also at the same time, the foreign exchange market would be very interesting in 2017. But I would seriously see that, considering the way that the Trump has already decided to make US a very great economy, I think the dollar directs would surely move up. Dollar directs would surely move up, and dollar indirects would go down, which is GBP, Aussie, Euro, and New Zealand dollar. I'm not in a situation to comment on Chinese yuan, because, in my personal opinion, today the fixing of the Chinese yuan is happening at 6.9, which is very high. I still remember that Chinese did a mistake by sparing approximately $1.5 trillion of our foreign exchange reserve, $1.5 trillion of our foreign exchange reserves. Uh, it's just to manipulate the fixing of Chinese yuan. I don't think so. This was the right decision, because still, because of Trump, because of the Trump now, because of the Trump now, Chinese yuan is trading at 6.9. So I don't know where this $1.5 trillion went, and sitting today, Chinese are having roughly $3.5 trillion of foreign exchange reserve, which is not very good, but which is still very less. So this was how the financial terminals move. In my personal opinion, that in the upcoming, I think probably next few weeks, Euro will touch down to 1.0450, from where we can have a selling call. We can have a sell call. We can have a sell call. GBP will go to 1.23, and Aussie, I think, will move to 0.73. Although commodities are picking up, and I seriously don't think that there is anything there is anything anything commodities to go, anything Aussie to go down, but I'm not sure why it is getting down. But I think it will touch 2.73, and the process would be very, very volatile. This is how things go. This is how our financial terminals work, and this is how our prediction. The only thing which I would like to mention to all of our readers, those who are watching our YouTube channel, is to be very careful, and when it comes to trading. We have our own foreign exchange desk. In case you want to trade with us, you are most welcome. And we'll also bring to your notice that we have our own online academy, in which we are teaching more than 13 courses. So if you are interested, you can you can join our course. This is a weekend-based course, and this runs on webinar. We are doing via webinar and webcasts. And also, over the period, we are launching many things. Our October 2015 magazine is already on the way. This is now in the public domain. I hope to see you. I hope you enjoyed this video, and you're welcome to visit our website www.regiconsulting.in, and my personal email ID is rahul.magan@regiconsulting.in. So thank you very much, and have a great day.